Why the IRS doesn't want you to know this? Here's the truth about audits and tax deductions. Did you know that fear of an IRS audit stops many Americans from taking tax deductions that are legally available to them? That's right. The vast majority of Americans are so fearful of audits that they would rather lose out on legitimate tax deductions than to claim them. Stick with me. I'm going to tell you the truth behind audits and the ability to claim tax write-off. Most people overestimate their likelihood of being audited. The fact is that less than 1% of tax returns are audited every single year. And for most Americans, if you're doing things correctly, your chance of audit is actually very, very low. In fact, even if you were to be selected for audit, again, if you have proof of your records, you have taken the right action steps during the year, an audit itself is not scary at all. What's also worse is that CPAs and your tax advisors often use the word audit to threaten you as a taxpayer. Commonly heard things are like, hey, if you were to claim this, you will be audited. If you write this off, the IRS is going to come after you. These are things that are actually inaccurate. And when we finally realize what our chances of audits are and how to legally claim these legitimate tax deductions, we can sleep better at night and we can be in less fear of IRS audit. One thing you've probably seen or have been told are these crazy images of auditors coming in like a SWAT team, basically knock down your doors and taking you to prison. Well, the reality is IRS auditors are normal people just like you and I. Their job just happens to be working for the IRS. And did you know that their job in an audit is not only to catch mistakes that you make, but they will also help you to find missed deductions as well. What they're required to do is if they find in the audit process that there are deductions or better ways to take position of a tax situation, that they have to let you know. And guess what? For the most part, they do let you know. And there are audits that actually result in a favorable adjustment, which means less taxes for you to pay, more tax refund for you. So we have to get away from this narrative and this unnecessary fear that auditors are like the ghosts and goblins that are out to get you. The fact is they are just doing their job and they are here to help ensure that we are doing the right things on our tax returns and taking the right tax deduction. You know, a common mistake that people think is that if I claim more tax write-offs, I am more likely to be audited. And that may or may not be true at all. It really depends on whether your deductions are legitimate or not and whether they're reasonable with respect to your real estate or your business. So for example, if I have a business where I sold $100 worth of stuff, but I'm claiming $100,000 worth of expenses, so odds are that this particular return might be audited, and you better be sure you have the right documentations to support why you claim that large deduction. But alternatively, if you have a business that's making $100,000, $200,000, $300,000 and you spend $5,000, $10,000, $15,000 or more on marketing expenses, office supplies, home office, business use of a car, a lot of times these are reasonable expenses. So don't think that taking legitimate tax deductions automatically increase your audit risk. And on the flip side, here is another common mistake. People tend to think that just because I'm not claiming tax deductions, then I will not be audited. And that's not true at all. I have seen plenty of scenarios where people choose not to claim deductions, but they are still audited. Why? Because they're not reporting the right type of income or they're not reporting the right income in the right places. A common scenario might be a real estate investor who reported their rental income on a personal tax return, whereas Airbnb might have issued a 1099 to their legal entity. And so now there's a mismatch and the IRS might want to take a look at it to say, hey, you know, Airbnb told me you made $25,000 of rental income in the LLC, but I don't actually see it on the LLC tax return. So how do we minimize our audit risk? First and foremost, we want to make sure we are reporting all of our income and we're reporting it in the right places on the right tax returns, whether it's your personal or your legal entity. You know, I talked a little bit earlier about the likelihood of an audit. And did you know that for those making under $400,000, there's an even lower likelihood of IRS audits because enforcement-wise, they're really targeting people with higher income rather than just targeting everybody. But for me personally, one of the issues I have with that is when the IRS says that they're going to target higher income people, that brings about this narrative that maybe they they think people who make higher income are more likely to be tax cheats, and that's not true at all. So nonetheless, that is what the IRS has signaled in terms of who they will audit. Like it or not, it's just not something that I personally agree with. All right, what are some things that, will increase our likelihood of being audited? First, I already talked about the fact that maybe you're not reporting the right income in the right entities. Another common mistake with respect to real estate is not reporting income just because it is not taxable. So a common example would be, if you owned your primary home and you lived there for the last 2 out of 5 years, you can get what's called a Section 121 gain exclusion. What that means is that the first $250,000 for single people or $500,000 if you're married, you can exclude up to $250,000 or $500,000 of capital gains from taxes if you meet this primary home tax gain exclusion. If I lived in my home with my husband, I bought it for $500,000, I sold it for $1 million. Well, guess what? That $500,000 gain could be completely tax-free under this exclusion. And so what happens a lot then is people don't report it on their tax return. But guess what? If you don't report it, the IRS did get documentation on the sale, so they might come knocking to ask, how come you didn't report the income on that property that you sold? And so for best practices, what I suggest you do is send all of your tax documents to your CPA. Regardless of whether you think it's taxable or not, make sure you send it to your CPA so that they can report it correctly and show the appropriate reason as to why something is non-taxable. All right, another reason people get audited is failing to report income. Believe it or not, all income received is taxable. This is a question I get all the time. What if I earn some income in cash? Do I have to report it? What if it just went directly to my PayPal or Venmo? Do I have to report it? Well, here's the truth, guys. You have to report all income earned regardless of how you received it. So making sure you properly report the income is what's actually going to help you reduce chances of audit. So as we talked about, the truth about audits is that auditors are not crazy people. They're very reasonable people, but it is up to us to make sure we report all of our income, and it is up to us to make sure we claim all of our legitimate tax deductions. So it's no secret that the IRS has significantly increased audit efforts, and yes, they are targeting real estate investors. But what does that mean? Well, it doesn't mean we should hide. It doesn't mean we should forego all of our legitimate write-offs and depreciation. What it does mean is that we want to be on top of our documentation even better than before. And what does that mean? That means having a good system for books and records. A question I get all the time is, how should I track my expenses? Well, the best way to track it is a method that works well for you. Why? Because you are the person who's going to be tracking your expenses. So if you're good with software, QuickBooks is probably the most common software that our clients use. But if you use property management software like Hospitable or Hemlane, there are also ways that your expenses could be tracked in that software as well. And of course, if you have a bookkeeper, it's just making sure that you provide the information to your bookkeeper timely so that you can document your expenses. Another question I get all the time is, should I keep copies of receipts? The answer is yes. And the reason for that is because, sure, you can prove via credit card statements that you paid $100 at Costco, or let's face it, when you go to Costco, it's probably more like $300, right? So you can prove that you spent $300 at Costco, but the receipt is what's actually going to tell the auditor what the $300 was spent on. So making sure you have the right documentation, proof of payment goes a really long way. As you know, for real estate investors, one of the biggest benefits we get is when we qualify as either real estate professional status or if we're using the short-term rental tax loophole. If these two terms are new to you, be sure to check out my other videos where I talk extensively about what those two qualifications are. With respect to audit though, it's really important to make sure we document our hours and be able to prove the amount of time that we spent on our real estate and what we did with respect to our rental properties. Now, the reality is there are going to be things that you're spending money on that you're just not sure whether it is a legitimate tax write-off or not. That's where your tax advisor comes in handy. Give them a call, send them an email, and just ask, right? Ask them, is this something that's a legitimate business deduction? And if the answer is gray or maybe, then the question becomes, how can I turn it into a legitimate business write-off? So here you go. We don't have to be afraid of the IRS. We don't have to follow the narrative of media that leads us to believe that auditors are very scary people who are trying to put us behind prison bars. Once you understand the tax law and you have an advisor who can help you take advantage of it, it's really nothing to be afraid of. Have questions about what tax deductions you qualify for? Drop those comments below or book a call with my team today.